everyone, and welcome back to the channel where we deep dive into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're putting a specific microcap name under the microscope, WLDS, or Wearable Devices Limited. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. WLDS, Wearable Devices Limited, operates in the cutting-edge technology and consumer electronics sector. With a market cap currently sitting at around $6.05 million, this company is developing a non-invasive neural input interface. Imagine controlling your digital devices, from consumer electronics to smartwatches, using just subtle, touchless finger movements. Their motor development kits are at the forefront of this innovation, aiming to change how we interact with technology. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? Essentially, it means there's high demand from short sellers to borrow shares, but very few shares are actually available. When you short a stock, you borrow shares, sell them, and hope to buy them back cheaper later. To do this, you pay a cost to borrow fee. This fee is an annualized rate charged by brokers for lending you those shares. If a stock becomes very hard to borrow, this fee can skyrocket, sometimes exceeding 100% annually, as we're seeing with WLDS. Why this stock is hard to borrow right now? Our screener flagged WLDS for its extraordinary cost to borrow fee, currently sitting at a staggering 778.1% annualized. This makes WLDS one of the most expensive stocks to short in the market right now. While we don't have current data on available shares to borrow, this exceptionally high fee strongly suggests supply is incredibly tight. WLDS has an estimated float of just 1.9 million shares, a relatively small number that can be highly sensitive to trading activity. Our internal composite squeeze score, which factors in CTB, float, volume, and technicals, gives WLDS a score of 48.5, indicating a moderate potential for volatility. Squeeze mechanics explained. A short squeeze occurs when the price of a heavily shorted stock rapidly increases, forcing short sellers to buy back shares to cover their positions. As the price goes up, short sellers face mounting losses, and the incredibly high cost to borrow fee on WLDS would only add to their daily expenses. This pressure can create a domino effect. Short sellers buy, pushing the price higher, which in turn forces more short sellers to cover, creating a rapid upward spiral in price. A shrinking supply of borrowable shares makes it harder for new shorts to enter and easier for existing shorts to get trapped. Dilution risk check. When evaluating any potential short squeeze candidate, dilution risk is critical. Dilution occurs when a company issues new shares, increasing the total share count and often decreasing the value of existing shares. This can negate or offset even the most potent short squeeze thesis. For WLDS, our check found no recent dilutive SEC filings, no -1s, -3s, or 424 BS in the last 90 days. This is a positive sign, as it means there aren't immediate public plans to flood the market with new shares that could absorb buying pressure. Recent reverse split watch. It's important to note that WLDS executed a 1-for-3 reverse stock split on June 22, which was about 57 days ago. A reverse split reduces the total number of outstanding shares and proportionally increases the share price. So, if you own 3 shares, after the split you'd own 1 share worth 3 times the previous price. While reverse splits are often seen as a move to regain exchange compliance or increase share price, they also reduce the float. Interestingly, many microcap stocks historically tend to see renewed volatility or a price pop within about a month or so after a reverse split, as the market digests the new share structure. This is a pattern observed in some names, not a guarantee for WLDS. Again, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's look at recent price action for WLDS. Today, the stock is down -1.48%. Over the last 5 days, it's seen a decrease of -11.92%. However, zoom out a bit, and WLDS is up a remarkable +69.43% over the last 30 days. Today's volume is notably low at just 89,900 shares compared to its 30-day average volume of nearly 3.4 million shares. This translates to a relative volume of 0x average, indicating very little trading activity today. Remember, a high cost to borrow doesn't guarantee a squeeze. It can also signal that short sellers have high conviction and are willing to pay significant fees to remain short. We need to see sustained buying pressure and increasing volume for a squeeze to truly materialize. WLDS presents a compelling case for observation, driven by its astronomical 778.1% cost to borrow and small estimated float. While the conditions for a potential squeeze are certainly present, robust volume and strong buying conviction are key. Keep WLDS on your watchlist and always do your due diligence. If you found this breakdown helpful, please hit that like button, subscribe for more hard to borrow insights, and let us know in the comments what stocks you want us to analyze next.